gold, and people are happily distributing this and using this as currency. But that was not all. The goldsmith now started lending out the gold of the people that had saved and deposited their gold with him. In other words, he was now lending out gold that was not even his. And not only that, he was issuing out scrips 9 for 1 on the borrowed money as well. And very soon the people became aware of this and said, you know, if you are now using our money, which you're supposed to be keeping in safekeeping, and you are collecting interest on it, well, we want our cut of the deal. So now the goldsmiths started paying a smaller interest to those people who would deposit gold with them and a higher interest to those who would borrow. And this was the beginning of banking. But remember, all the scrips in circulation were backed by gold. In time, we had a situation that arose in ancient England where the goldsmiths came together and made a proposal to the king. You see, the goldsmiths were aware that the king needed money. The king was at war with France, wanted to raise an army, needed money. And they came up with a plan. We will give you what you want in return for you giving us what we want. And they promised the king that they will give the king, they will loan the king whatever amount of gold that he wanted. And all the king had to do was simply pay back the interest on the gold. They didn't want the gold back, just the interest. But when they issue the gold, they won't issue the actual gold. They will keep the gold in safekeeping. They will issue a script. And the people will accept this script from the king because they know it is backed by gold, because they have the gold in their vaults. And they will issue as much gold as the king wants. The king trusted them, assuming they've had the gold. They were issuing script for gold they didn't even have. But the script was popular and was accepted. So we had a situation where the goldsmiths were lending money which they didn't have, but they asked for one additional concession in order for the king to get what he wants. The king must issue a decree that they alone must have the right to issue script backed by gold. The only people that must have the right, in other words, a monopoly on the issuing of paper money. And the king agreed to this. And this is where we had the beginnings of the formation of Central Reserve Banks. The Central Reserve Bank was a private bank that was lending money to the king. Today, the situation is absolutely unchanged. The government has laws in place that protects the monopoly of the reserve banks to create money, and the banks in general to create money. They have that monopoly, and the Reserve Bank, even in America, even in South Africa, the Reserve Bank is a privately owned bank. So here we have a private bank with the monopoly to manufacture money out of fresh air, but when the government wishes to borrow money from the bank, they purchase from the Reserve Bank, they purchase from the government. The Reserve Bank will purchase from the government bonds. And in return, the government has to pay interest on these bonds, which means basically the money that the government borrows, interest has to be paid on it. Now, the peripheral banks create most of the money. Most of the money is actually created at the level of the banks, and money is created every time somebody borrows from the bank. There is no money. Once you go and borrow from the bank creates a journal entry that says you have deposited 100 Rand with them, and they have issued you a loan with 100 Rand. So they issue a loan with 100 Rand, and you've deposited that amount of 100 Rand, and so that 100 Rand is created out of fresh air, and that 100 Rand is reflected as an asset in the books of the bank. Now on that 100 Rand, the bank can now issue a loan of another 900 Rand. And when that 900 Rand is issued, it is reflected as a deposit, which means now they can issue another 900 Rand for every 100 Rand that's deposited. And so we have this fictional creation of money. not backed by any assets, not backed by any security, simply created out of fresh air. When an individual goes to the bank to claim his money, the bank must be able to issue it. And if the bank cannot do that, the bank is actually insolvent. So while the bank is able to create money, it has to follow a very close line, because they must be careful not to go into insolvency. Okay. What is this issue of the bank having security with the Reserve Bank? The bank must have 10% of its equity with the Reserve Bank. In other words, the amount of loan that the bank can issue is based on how much of security it has with the Reserve Bank. But we've got to ask ourselves, what is the real purpose of this security? Because it's only 10%. It can't cover the debts of the bank. From my understanding, the only reason the Reserve Bank makes this requirement is because the Reserve Bank wants to have control and wants to be informed of how much of money is actually created in society. Because based on the amount of security it has, it can extrapolate how much of potential money can be issued in society. And if the Reserve Bank wants to reduce the amount of security in society, it will reduce its holdings of security of the bank. So the Reserve Bank can actually control the entire economy. Now, here is a very important aspect. How is all this related to slavery? We know that these people are making money out of fresh air. We know that we have to pay them interest on this money that's created out of fresh air. So they are constantly siphoning off the wealth of society. In order to understand this, in order to have a better understanding of this, we need to look at a theoretical situation that goes back to the very beginning when the first banknotes were issued. In terms of this situation, let us assume theoretically that there is now no money in circulation and the first person goes to the bank in order to borrow money. Now I am giving small figures so that we can understand what we're talking about, but the figures are very large. They go into billions and billions of rands. He goes to the bank and he borrows 1,000 rand. Now this society has in itself 1,000 rands which this person has borrowed, and he's buying goods and services for that 1,000 rand. So that money is now circulating within that society. At the end of the year, with 10% interest, that man has to pay back 10%. He has to pay back 100 rand to the bank. In other words, that society as a whole, because there are a large number of people borrowing, has received from the bank a sum of 1,000 rands, but at the end of the year it's owing back to the bank 1,100 rands, which means right at the very outset that society is in debt to the bank, because only 1,000 rand has been created, not 1,100. Where are they going to find that 100 rand to pay back the debt?